All right. Well, hey, everybody. Thank you all for coming today. I wanted to start off our review by talking about fixed income. That is something that, as part of the investment team, I've gotten to work really closely with over the last little bit, and I think that it plays a really important role in a lot of our portfolios. So to start, I think it would be productive to just recap what the Fed has done as of lately. They started their rate hike back in 2022, and the last one that got us up to where it is now was in July of 23. It's remained steady there since then at 5.25 to 5.5%. And there was a little conversation about whether they would continue to hike or if they would cut. But at the beginning of this year, the market felt pretty confident after some data came out that they would start cutting at some point. How much they would cut, though, we were really unknown about. They were projecting 6 cuts throughout the year, and I think that that kind of narrative you can see in the way that the market rallied in the first little bit of 2024. People were really enthusiastic about that, and companies being able to go forward on projects at a lower expense to themselves. And in addition to that, intermediate and long-term treasuries went up slightly as well, which helped to kind of flatten the curve for a small amount of time. But of course, more data came out, and once the Fed started speaking throughout the first half of the year, it became clear that there might be one cut, if any, this year, and then next year would be a different conversation. So as of now, the curve is still inverted. And as you can see in this, I think it's kind of interesting because if you compare the 3-month and the 10-year yields, right now, as of June, there was a 1.09% spread, whereas this time last year, it was at 1.88%. So that shows that there is a shift happening, and ideally our goal is that we want to see this normalize and go the opposite direction, but that won't probably happen until we start seeing cuts from the Fed and investor sentiment changes to be more market focused. In addition to that, the Fed did come out in May and they alluded to a December cut. So I think that that has been more of the story that we're seeing. And in July, Jerome Powell came out and further gave us more belief in that, confidence in that, by acknowledging that progress had been made as far as monetary policy was concerned, and that the Fed was waiting to have more confidence before they cut, but they just want to see a trend towards 2% inflation. It doesn't necessarily have to achieve that 2%. So if you're interested in following that, like I'm a consumer, so of course I want to know when that's going to change, you can watch the personal consumption expenditures measurement, the CPI, the Consumer Price Index is what that is. And then jobless claims is also, they want to see that jobless claims is slightly increasing, and they want to see that those other 2 inflation indicators, PCE and CPI, are going down. The jobless claims one, I just, as a side note, I don't necessarily mean to say that they want that to shoot up, but if it was starting to rise, I think it would signal to them maybe they need to take some measurements and lower those rates for the sake of the economy. So what we're seeing now when we go out and we buy these fixed income positions, short-term CD rates are very heavily anchored to what the Fed target rate is. So right now it's really still accessible to go out and get 5% or higher in something that's a year or less. That has changed slightly over the past month if you've been following it closely. Now that the Fed has been speaking, and the election, I think, has had a little bit of a sway too on how people are seeing things. The CDs that we're seeing 7 months and beyond are falling slightly below 5%. So I think that trend will continue, especially if the Fed does start to cut. But that's where it's at right now. And then in addition to that, most companies aren't coming out with new issues of debt because they are anticipating that a cut is on the horizon. But if they do, they're coming with call features. So we typically try to avoid that if possible, just because we want to lock in what we're getting. We don't want it to get called away from us in a year if rates go down. But that is part of the environment that we're working with now. So we're trying to be selective there as well. And then in addition to that, the last 6 months in working with fixed income, it has become more difficult to find those like investment grade, household name corporate bonds that are paying over 5%. It is still there. The yield is still accessible, but it is becoming more of a challenge in that regard. So I've got a couple of examples listed as to this would be what we see in a typical week from our bond dealers. You've got Mondelez International, CVS, Altria, and Discover. Those are all great companies that we like to see in our corporate bond lists. But something I want to point out, for example, Mondelez paying 6.5%, that is priced at a pretty significant premium. And I would say that in 2023, when we were looking at that, it wouldn't have cost so much to buy that bond. So it's still yielding 5.2%, which is attractive, and that's what we're looking for. But in the mix of all of these, I would imagine we'd go with something more like CVS. The yield to maturity is higher, and that's important for our strategy, which I'll talk about a little in the next slide. But that just tells me that that's the best return, the best coupon for the best price. And so that's kind of what our scope would be in a situation like that. And just to focus real quickly on what our strategy looks like, because I think that AFI is a little unique in the way we handle fixed income. A lot of investment advisors tend to put their people into mutual funds and other fixed income funds that give them an overall general experience of fixed income, but we choose to go about it actively. So we're buying individual positions with the hopes of holding it all the way out into maturity. That way we know exactly what we're getting, we know what it's going to be paying, and we can be more strategic. Like if rates are going up, we don't have to buy something with a long duration so that we can reinvest at a higher rate next time. It just gives us more control over that fixed income position. So it starts out, we have a weekly surveillance of our bond maturities and what's coming due. This helps us to identify maturities that have just happened or are about to come up. That way we don't have cash sitting for too long in people's accounts. We're able to get them invested quickly. And that's really important right now with rates being on the verge of dropping. We want to make sure we lock in as much as we can as quickly as possible. So another aspect of our fixed income system is the bond dealer relationships that we hold. Bond dealers are those who are tasked with, that's pretty much their entire day, is that they focus on the bond market, they look to see how those rates are moving, and then they communicate with us what they're seeing. So it gives us an expert insight for our own considerations, but they also provide buying opportunities that aren't available through the Schwab platform. So those companies that I showed on the previous slide that we all recognize, those are not so available if you go through Schwab's Trading Center, but they can get us better prices when we have those relationships. And then CDs are a little bit different. CDs, especially now, are very popular because those are the safest form, I would say, one of the safest investments you could have for your money. And we are able to access them on a national scale through Schwab. So instead of being constricted to our local markets like Eastman Credit Union, Knoxville TVA, we're able to go out and buy CDs from credit unions and financial institutions in New York and in Texas and wherever the yield is most attractive. Right now, I think that has been really positive too, because we can compare and see what local institutions are offering versus what else is out there. And then a part of our strategy that I kind of touched on is that we are focused on holding into maturity. I think a really interesting way to show how that's been beneficial is if you look at the Barclays U.S. Aggregate Bond Fund, their performance this year to date has been down 7.7%, and last year they were down 13%. And the reason for that being is because rates were increasing, and the fund suffers from that because those underlying assets are sensitive to the price changes that occur when rates go up. Whereas on our side of things, we were able to come in and continuously buy those 5% maturities or 5% opportunities as things matured. And we're holding that through as these rates fall, we'll still have that 5% locked in, which is really beneficial to the portfolios, especially in a falling rate environment. So with that being said, I'm going to pass it along to Peter now to talk about the other aspects of market outlook.
Yeah, absolutely. Thank you. And Kelly does a tremendous job on our fixed income. She's kind of selling herself short a little bit on the work that she does with these bond dealers, because the bond dealers, as you can imagine, are very similar to used car salesmen. And so you get some that are very aggressive about, you need to buy, and then you get others that just show you their inventory. And Kelly and Brian do a tremendous job dealing with, we've got a couple primary, and then a lot of times what we're able to do is take what's available on the Schwab platform where you can just, it's kind of, you see it, you buy it type thing. We can take those out to the bond dealers and say, can you match this, or can you get us better rates? And they do a tremendous job on that. And fixed income, I really feel like is one of those places that if you're willing to put the work in, it can be a major differentiator for long-term performance. And that yield to maturity strategy that Kaylee was referencing, we might also take that same issue where the underlying bond goes from $100 per bond to 97, but we know we're getting that 100 back versus being a fund where they've got to keep on buying, to meet their profile, and you're not sure when that's going to come back. So there's a lot of kind of manual labor that goes into that, and they do a great job with it. I guess I'm tasked with talking about the equity markets, and it's been kind of a wild ride this year. As Kelly said, the interest rates being expected to come down, we saw the first quarter shoot up, and then we've seen everything kind of back off a little bit and then move higher as different things have happened. But this chart really kind of shows how different the market is. So that column in yellow is for the first half of 2024. You've got the different quarters there, but you can see the NASDAQ composites up 18.6% through the end of the first half of the year. When you get down to the Dow Jones, what you would normally consider kind of that bellwether of what financial market reporting is at, even though it's only, 30 stocks, then it's only up 4.8. The S&P 500 is up 15. And so that difference has been driven very specifically by two things. One has been interest rates, so how different companies are affected by, the interest rate play. And then two, and there's a slide later in this presentation talking about it, kind of the Magnificent Seven. There's 7 stocks that are driving all of the market performance right now. And if you look at the S&P 500, so the 500 biggest stocks in the country, if you take those 7 stocks out through the end of the first half of the year, the performance was right around 3.5% on average for all of those stocks. But as you can see, S&P's up 15. This is a breakdown of the sectors, and you can see where those 7 would fall. They fall in technology, communications, and then there's a massive drop-off when we get into energies and financials. And one of the interesting things off of this chart that I kind of wanted to point out is you can see some of the sectors that did really well in the first quarter. So take financials, for example. They were up 12.4 in the first quarter. The market is a forward-looking indicator. And so if you're expecting rates to come down and you're a bank, your mortgage never comes down, immediately when they get cheaper money from the Fed. Your car rates don't come down immediately. There's a lag. So there was the expectation that they were going to have cheaper money for them to continue to lend out at higher rates. When that didn't happen, we've given up, about 2%, and now we're up about 10. So still a good year for financials. There's still the expectation that financials are going to do well as interest rates come down, but nowhere near what coming out of the gate thinking that we were going to get this large kind of seismic shift in interest rates were going to be. And then if you look at real estate, very bottom, so REIT, real estate investment trusts, as you can imagine, 8% mortgages has not done much. The other big issue that's affecting them is if you look at the commercial space right now, the work from home kind of shift has led to a lot of empty office buildings. So if you look at like regions where we were at, you got Appalachian Orthopedics still up on the 3rd floor, but we've vacated 3,500 square feet of real estate. That entire 2nd floor is empty and has not been filled. That's been over 2 years now. And then you have the bank on the 1st floor, and you're seeing that all over the place. You're seeing it in malls as well. I mean, it's just that commercial real estate space is really been affected, especially with interest rates. The development has not kept up with demand in the residential space, but we also have kind of this glut of inventory in parts of the commercial space. So if in the real estate space, we still like some of the home builders, like Pulte Homes, because there is such a lack of supply, and we're going to have to fill that out. But interest rates have played a big part in in that suppression. If we do see rates starting to come down, my expectation is that they start cutting rates in December. You still have some firms out there who think that we're going to get 2 rate cuts. I really don't think they cut before the election. I don't think the Fed has any interest in being labeled as being politically motivated, especially with all the craziness that's going on. So that would leave them the December rate cut, and I do think that one probably happens. And then maybe a couple into the beginning of next year that we would start playing on. This is kind of a summary of all the various things. So in the first half, you've got gold and silver have started to make some moves up, but the overall commodity market's only up 5%. A big part of that is natural gas is down 14% this year. Part of that is executive order driven. Part of that's just the realities of the economy, everything going on Russia, Ukraine. We have seen oil moving higher. If we look into the global section, so that's that upper right-hand section of this chart, you can see not a lot of positive movement. Brazil down huge, Mexico down. Really, the only thing that you've got positive, you've got Italy in that chart, not listed in there. You do have, believe it or not, Taiwan doing really well, which is a little bit of a surprise considering all the jawboning back and forth. But they're up, easily over 20% year to date. So international continues to lag. These are kind of that same sector. The British pound, euro, and the yen, the US dollar has continued to be strong. We're up 4%, give or take, across various currencies. And so that narrative that we see in financial news and, dare say propaganda is that the US dollar is going to collapse and that we just, we're losing our place as the world economy. The US dollar just has continued to strengthen, which has hurt us from our exporting standpoint. So it makes our goods harder to sell overseas, and it helps imports. So that's one of those things, if you look kind of over onto this chart of GDP, we're still positive. So we're up 2.1% is year to date, is the June year over year. And the expectation and the changes in the SEP, this is numbers out of the Federal Reserve, are for basically 2% growth for all of 2025, 2026. Not great, right? 2% growth isn't anything to write home about, but it's not a recession either. So 2% on top to 2%. And generally, if you're not in a recession, the market's moving higher. The degree to which you move higher, I'd love for these numbers to be up in the 4s and 5s, but we're just not there. So if we can get inflation down, and that's kind of the big problem with 2% GDP, is if you're inflating at 3 or 5 or 7, you're really contracting in real dollar terms because dollars aren't buying as much. But inflation seems to be kind of sticky right here. The year over year numbers right now are right at 3. So if we look at core PCE, personal consumption expenditures, that's at 2.8. And the expectation, as you can see, is a little bit higher for 2025 than what our GDP will be, and then 2% in 2026. And as you can see, I guess the expectation would be FFR is Fed funds rate. So right now we're at 5.1. The thought process would be, if we can cut rates into the upper 3s in 2025, and then maybe down to, right at 3 in 2026, that in theory would boost the economy enough that your economy is growing faster than inflation. But it's also going to cause inflation. It's a tight balance. So if we look at real Fed funds rate, so this is just Fed funds rate minus personal consumption, it's not great. But that's a long-winded way of saying the expectation on the market and the expectation out of the Federal Reserve is kind of for this muddle along, slow growth, blah, right? But what's really interesting about it is our blah is still better than pretty much the rest of the world. So if you look in Europe, you look in a lot of places, the only places that have higher numbers than we do, for the most part, are China, which who knows if those numbers are right, and they're collapsing compared to what they used to be. So their numbers are right around 5%, and that used to be 9+ all of the time, but we really, China's economy is really crumbling. Their real estate market has just destroyed large parts of the market, but it's a black hole. And there's so many things there that are run by state-owned entities and everything else that those numbers are hard to tell.
Hard to believe.
Yeah, it really are. This is kind of going towards that Magnificent Seven, growth versus value. So the first quarter, everything was kind of moving higher. Russell 1000 is large companies, 1,000 largest companies. Russell 2000, that's basically small companies. In that first quarter, everything was doing really well. The growth was all happening, in Amazon, Apple, Tesla. I guess the Magnificent Seven. So that's going to be Microsoft, Amazon, Apple, NVIDIA, Google, and Meta. And I'm missing one more.
Did you say Tesla?
Tesla's in there. So those 7 are driving everything. And Tesla really has had they're flat for the year. They're down significantly from where they were. They had collapsed, in the middle part of this first half of the year, but they've recently, with some of their factory orders, come back. So they're no longer being a drag. But that thought process of, well, when is value going to have a place in a portfolio again? It's hard to beat AI-driven stocks. Will I take 6% on value? Yeah. Would I rather have 20%? That's a hard split, right? If that was 8 for risk and 6 for safe, I'd be like, okay, well, it's really hard to give up on those high flyers. And this is that Magnificent Seven. So the blue, this year to date, Magnificent Seven are up 37% this year. Those 7 stocks. S&P 100, which is the 100 biggest, and the S&P 500, still doing well. I'll take a 19 and a 15 all day long. This one's really interesting. So if we look at the green, what that is if you equally weighted every stock in the S&P 500. So right now, when you look at financial news, Apple, because it's so big, counts for 20% of the S&P 500, or whatever the number is, right? If you made it worth 1/500th of your returns, and then 1/500th for Microsoft in each of those, that's where that return comes in at 5%. Small caps, which you would traditionally think of doing well as an economy, starts to heat back up because those smaller companies now have the opportunity to do things. They still are floundering. So it's kind of, the thought process has been, since 2009, it's been hard to beat the S&P 500. Doesn't really matter what asset class you've been in. If you weren't in the S&P 500, you've lagged that. But even within that S&P 500, it's the tech stocks. And so the NASDAQ beating, just the pants off of everybody. The risk there, and the reason why maybe you would be like, well, why don't I just put all my money there, is you get a year like 2022, they were down 34%. And whether or not you can take that type risk on your portfolio, when the rest of the market was down 20, they were down significantly more. And so that's going to be the risk going forward, is how much of a premium are these AI-driven and technology-driven stocks worth having in your portfolio, and the capital gains that they cause and everything else. So that's going to be kind of that task for the next part of the cycle. In looking forward, obviously we've got the election. That's going to create a tremendous amount of volatility. My stance hasn't really changed, even with an assassination attempt, with a candidate dropping out, with everything else. The market in general does not care who wins. They want a winner. Individual stocks care very much. So like that natural gas example that I gave earlier, the expectation would be that, for example, if President Trump were to win, you would see kind of this reversal of all the executive orders that President Biden put in. One of those would be very, affecting natural gas. So you'd see a stock like that reverse. But the market in general would move higher. If we get through the election and it doesn't end up at the Supreme Court, then I think you get a rally into the end of the year just from relief that we're past it. The shift to Vice President Harris being the nominee opens up some legal challenges that could be there. It opens up a lot of different things. So we'll just see where that plays out. I continue to think that if you don't have a winner or a path to a winner in the very short term after the election, you will see a market correction. Is that a 5, 10, 20% correction? Hard to tell. It will depend on what the, I guess, issue is. In theory, that would be resolved by whatever resolution happens. You would kind of V-shape recovery if you had a, election that went to the Supreme Court. Out of just nervousness and everything else, you'd see a market sell-off. And then whatever the result, okay, we're still existing as a country, and we have a president, you would rebound. Because fundamentally, when you look at unemployment and you look at all the metrics of the economy, there's not a reason for us to experience a sell-off. You could see a sell-off in the tech stocks, which would drive the market down significantly. When you have the bulk of your market not doing that great, I mean, they're up 4 or 5%. If the things that have driven you higher give that up, you could see kind of, they're not strong enough right now to hold up a crash in the tech stocks. I don't see a crash in the tech stocks happening necessarily quickly, just because everything's being driven that way. Even, this last week, so we saw CrowdStrike, lovely CrowdStrike, where we shut down all the airlines because of, software. One line of code took down basically our entire airline industry for a number of hours. We actually didn't have the ability to place online trades at Schwab, for a little while there. So those type of things can structurally happen, but we kind of shrugged it off and we've moved on. CrowdStrike hasn't. CrowdStrike's an interesting case now. We'll see if that's the buying opportunity or if it's the beginning of kind of a fall for them. I think if it truly was one line of code, it's kind of like when you have a drug company that has, a class action lawsuit or something like that, they will get past it and then move on. If it's more, systemic than that, and it leads to contracts cancellations, you could see some issues there. But I do think we've got a chance to keep this market going, but everything hinges on the election. Speaking of the election, right now the predictions, if you go to Vegas, are all over the board. But there's really kind of 3 primary possibilities. A Republican sweep, so the House and the Senate shifting to being Republicans and President Trump being in office. In that scenario, that's the one that I actually think you've got the most possibility for things to change in the future, just because that puts the filibuster right in the crosshairs. So where we've been talking a lot about taxes going up when the 2017 tax cuts expire, if the filibuster goes away, then you could see some movement there on taxes and everything else. In either other scenario, with a President Harris or President Trump with a split Congress, you're basically looking at what we've had for the last 8 years. And really go further back. So other than maybe the 2 years there where Trump had full control and the 2 years where President Obama had full control, that's what we're looking at is gridlock in Washington, a lot of executive order action, little movements here or there, but that's kind of what our expectation is, for the political theater. So as long as they can avoid wrecking the system, which I used to put it at like 1% chance. Who knows what it is now? Is that a 5 or is it a 10 or is it higher? That's kind of the big thing there. The other question that we get a lot is how much debt is too much debt. So I wanted to spend a brief moment on this. Right now, if you look at, this is U.S. debt held by the public as a percentage of gross domestic product. We've been here before, so 40s and 50s, we were right here. Volcker came in shortly, in this time period too, and kept interest rates extremely high. And we kind of drove this down. But with COVID spending, with Great Recession spending, all that, we're right back there. And the question we get is, well, don't we have to pay this off at some point? We don't. But there is potentially places where the interest becomes so high that it's kind of a point of no return. And what is that point of no return? It's all guesswork. But the thought process is, so IMF has a paper out that, the average is 172, but it's between 160 and 183. The Wharton budget model says at 188, we become unsustainable. But if you look at like the United Kingdom post-World War II, they were at 248. So there's hope. It's not and you look at how long it would take us to get there, 2050, which will be here before you know it, but it's still a ways out. So making investment decisions now based on it is not necessarily, viable, but we are getting there. There's a lot of things that go into that big debt number that we see. One is intergovernmental loans are a big part of it. So that's why this number is maybe lower than at 99 than you've seen in else place, because this factors out the fact that we borrow from Social Security to pay over here. That's technically debt of the United States, but the United States isn't going to do anything about it. So there's, out of our total debt, there's between $7 and $9 trillion that's intergovernmental. The other big issue that a lot of people bring up is, well, what about all the debt that China owns? Right now, and that number has been coming down very heavily, the number one holder of debt of the United States right now is actually Japan. And Japan's actually had to just sell some of their debt and raise, some money on their side because they're having economic problems. They're having to support their currency. But China wants to keep that amount, but they're kind of dropping. What isn't talked about very often, because they have right around $850 billion of U.S. debt, is the United States has $850 billion of Chinese debt that we could, and we haven't done anything about it. The UK did some stuff about it, but we could force the Chinese government to pay us that back. And, the UK did that with some of their rules, and I would imagine, depending upon who's in the White House, that will maybe determine how aggressive we are about doing that. But if you look at kind of the United States across all other countries, there's net foreign assets. We own more foreign assets than are owned of ours in terms of debt. So it's not as dire or as immediate maybe as some would think. And it all is based on the idea of who do you trust? And right now, nobody trusts the United States more than, and if there was a viable alternative to the United States, I would think, we're in that position where we start to have to be worried. But, the EU can't seem to get their act together. They were at one point thought to be taking kind of that leadership role. Nobody wants to trust China. This war with Russia and Ukraine is draining the Russian economy, and we're fighting this proxy war that's weakening all of our enemies through that. So it does give the United States a pretty large runway that even with debt being so high, that it shouldn't derail the economy. And I don't think that, I've seen a political candidate anywhere, actually come up with a plan to reduce it. So I would just expect it to keep going up. And that's kind of the market expectation. So, that's kind of the thought process on debt is I do think it keeps going. The one hope would be, because we measure it as percentage of GDP, if this AI revolution kind of supercharges GDP growth, then this becomes a much smaller issue. Because that increases the tax base, it increases all the different things that work there. So that's what we're seeing. So I'm going to pause there because I talk a lot and, open it up for questions. But that's kind of a review of what's been going on and what we see going forward. I don't see great things, but I don't see kind of that flip over into a recession collapse. We need to make massive portfolio changes because of it type scenario.